Tonight, we're going to talk about something that's going to completely reshape how you think about your savings account, about financial stability, about everything you thought you knew, about what keeps the global economy from collapsing. We're going to explore the largest pool of savings ever accumulated in human history, and the invisible architecture that makes modern civilization possible. And I have to warn you right now, by the end of this, you're going to look at that money sitting in your bank account very differently. You're going to understand something that most people, even most economists, never fully grasp, something that makes even trillion-dollar stimulus packages look like band-aids on a system that runs on something far more fundamental. If you enjoy these deep explorations into finance and economics, consider subscribing or hitting the like button. It really helps the channel grow and allows me to keep making content like this. Let's begin with something familiar. Your wallet. Right now, you probably have somewhere between $20 and $100 in cash sitting in your wallet or purse. Maybe it's a couple of $20 bills, some 5, a handful of ones. This is money you can touch, money you can spend today. It's immediate. It's real. It's a scale that makes perfect sense to your brain because you use it every day. Your brain evolved to understand amounts like this. $20 buys lunch. $40 fills your gas tank. $100 is a decent dinner for 2. These are transactions that feel natural, comprehensible, human-scaled. Now let's look at your checking account. The average American has about $8,000 in their checking account at any given time. That's money that's available immediately. You can transfer it, spend it, withdraw it. It's liquid. It's your operating capital, the money that keeps your daily life functioning. $8,000 might represent a month or 2 of expenses, a small emergency fund, the buffer between you and financial stress. But here's where we start climbing the ladder. Your savings account. According to recent data, the median American household has about $5,300 in savings. The average is much higher, around $41,600, pulled up by wealthier households. Let's work with that $41,600 figure for a moment. $41,600. If you saved $100 per week, every single week without fail, it would take you 8 years to accumulate that amount. 8 years of discipline, of setting aside money consistently, of delayed gratification. That's not a small achievement. That's nearly a decade of financial patience. Think about it in terms of time. If you earn the federal minimum wage of $7.25 per hour and somehow manage to save every single penny, you'd have to work 5,738 hours to accumulate $41,600. That's working 8 hours a day, 5 days a week, for nearly 3 years, and keeping absolutely every cent. No food, no rent, no expenses whatsoever. In reality, of course, this is impossible, but the thought experiment shows you something important. Savings represent stored time, stored labor, stored life. If you converted $41,600 into $1 bills and stacked them, the stack would be about 3.5 feet tall. You could lay those bills end to end and create a line nearly 4,000 feet long, about 3/4 of a mile. That's a lot of dollar bills. That's a lot of small decisions to spend less than you earn, accumulated over years. But compared to what's coming, this personal savings amount is microscopic. It's the starting point of a journey that will take us from your checking account to the foundation of global economic stability. Most people think about their savings as just money sitting there, doing nothing, maybe earning a tiny bit of interest. They think of it as inactive, as opportunity cost. That money could be invested. Financial advisors say, make your money work for you. And there's truth in that. But what almost nobody understands is what savings actually do in the broader economy. The role they play, the stability they create. Your $41,600 in savings isn't just sitting there. It's part of something much larger. And we're about to understand what. Let's zoom out one level. The average American household. Not just your personal accounts, but everything in the household combined. Checking accounts, savings accounts, money market accounts, certificates of deposit, all the liquid savings a household has accumulated. According to the Federal Reserve Survey of Consumer Finances, the median American household has about $8,000 in total transaction accounts. But the average across all households, is approximately $42,000. For households in the top 10% of earners, that number jumps to around $173,000 in liquid savings. $173,000. Let's sit with that for a moment. If you saved $500 per month, which is substantial for most people, it would take you 28 years and 10 months to accumulate $173,000. Nearly 3 decades of consistent saving. Most people's entire working career from their 20s to their 50s. If you had $173,000 in physical cash and you weighed it, using the fact that a dollar bill weighs about 1 gram, you'd be holding 173,000 grams, or about 381 pounds of currency. That's roughly the weight of 2 adult male lions. You couldn't lift it. You'd need help moving it. But here's what's interesting. This money, these household savings, they don't just represent purchasing power. They represent something more fundamental to how the economy actually works. They represent stability. They represent the capacity to weather unexpected shocks. Medical emergency. The household with $173,000 in savings can handle it without entering a financial crisis. Job loss. They have a runway, time to find new employment without immediately defaulting on obligations. Now, there are approximately 131 million households in the United States. If we use the mean savings of $42,000 per household and multiply it out, we get approximately $5.5 trillion in household liquid savings. That's trillion, with a T. $5.5 trillion. Let's put that in perspective. If you had $5.5 trillion in $1 bills and you stacked them, the stack would be approximately 375,000 miles high. That's more than 1.5 times the distance from the Earth to the Moon. You could stack dollar bills from here to the Moon and back to Earth, and still have bills left over. If you tried to count to 5.5 trillion, counting one number per second, 24 hours a day, 7 days a week, without ever stopping, it would take you approximately 174,484 years. Modern humans have only existed for about 300,000 years. You'd be counting for more than half of human existence. This $5.5 trillion in household savings is already an incomprehensible amount. But we're just getting started. This is still just one country, and it's just household savings. We haven't even talked about business savings, institutional savings, government reserves, or the massive pools of capital held by corporations and financial institutions. The scale is about to explode. Households save money, but so do businesses. And the amounts they save dwarf household savings completely. Let's start with a single company, Apple Incorporated. As of their most recent financial statements, Apple holds approximately $162 billion in cash and marketable securities. $162 billion. One company. That's more cash than the combined GDP of 130 countries. It's more than the entire annual economic output of Hungary, or New Zealand, or Vietnam. One company has more liquid savings than the entire productive capacity of nations, with tens of millions of people. If Apple's cash reserves were divided equally among every person in the United States, every American would receive about $485. If you tried to spend Apple's cash at a rate of $1 million per day, it would take you 444 years to spend it all. You'd have to start spending in the year 1580, during the reign of Queen Elizabeth I, and you'd just now be running out. But Apple isn't unique. Microsoft holds about $104 billion in cash and short-term investments. Alphabet, Google's parent company, holds approximately $110 billion. Amazon holds about $73 billion. Meta, Facebook, holds roughly $65 billion. Just these 5 technology companies alone hold approximately $514 billion in cash and liquid securities. $500 billion sitting in corporate treasuries. That's roughly equivalent to the entire GDP of Belgium or Thailand. And we're only talking about 5 companies. There are thousands of publicly traded corporations, each holding their own cash reserves. Small businesses, too, maintain operating cash, emergency funds, reserves for expansion. According to the Federal Reserve's Financial Accounts of the United States, non-financial corporate businesses hold approximately $4.5 trillion in liquid assets. Financial corporations, including banks and investment firms, hold even more, approximately $3.8 trillion in cash and short-term investments. Combined, we're looking at roughly $8.3 trillion in corporate liquid savings, just in the United States. Add that to the $5.5 trillion in household savings, and we're already at $13.8 trillion. $13.8 trillion. If you laid that amount in $1 bills end to end, you'd create a line approximately 1.3 billion miles long. That's enough to reach from Earth to Saturn when the planets are at their closest approach. You could stretch dollar bills from Earth past Mars, past the asteroid belt, all the way to Saturn, and still have bills remaining. But here's what most people don't understand. This money isn't just sitting there doing nothing. It's not lazy capital, despite what some economists argue. These savings, both household and corporate, are the shock absorbers of the economic system. They are the buffers that prevent small problems from cascading into catastrophic failures. When households have savings, they don't immediately default on mortgages when they lose a job. When corporations have cash reserves, they don't immediately file for bankruptcy when they have one bad quarter. This stability, this capacity to weather storms, is what prevents the economy from being incredibly volatile and fragile. But we're still just talking about one country, and we haven't even discussed the largest pools of savings yet. The amounts held by governments, by sovereign wealth funds, by central banks. The truly massive reservoirs of capital that underpin global economic stability. The scale is about to shift in a way that's hard to comprehend. Governments save money too. They call it reserves, or sovereign wealth funds, or foreign exchange holdings. And the amounts they accumulate make even large corporate cash piles look modest. Let's start with the United States government. The U.S. Treasury holds approximately $775 billion in cash and other liquid assets. 750 billion kept in government accounts to fund operations, pay obligations, and manage short-term financing needs. But the U.S. is actually relatively light on government savings compared to some other nations. This is because the U.S. dollar is the world's reserve currency, giving the U.S. unique advantages. The U.S. can print the currency that everyone wants, reducing the need to hold massive reserves. Other countries aren't so lucky. They need to hold reserves of foreign currencies, particularly U.S. dollars, to facilitate international trade, to defend their own currency values, and to provide stability in times of crisis. China holds the world's largest foreign exchange reserves, approximately $3.2 trillion. $3.2 trillion, held by the People's Bank of China in U.S. Treasury securities, gold, and other foreign currencies. If you tried to count to 3.2 trillion, counting one number per second without stopping, it would take you over 101,000 years. The last ice age ended about 11,700 years ago. You'd have to start counting before the ice age, continue counting through the entire development of human civilization, agriculture, writing, the rise and fall of every empire in history, and you'd still be counting today. Japan holds approximately $1.3 trillion in foreign exchange reserves. Switzerland holds about $900 billion. India holds roughly $640 billion. Russia, Saudi Arabia, Taiwan, Hong Kong, South Korea, each of these countries and territories hold hundreds of billions of dollars in reserves. According to the International Monetary Fund, total global foreign exchange reserves amount to approximately $12.1 trillion. $12 trillion, held by central banks and monetary authorities around the world. But that's not all. Many countries also maintain sovereign wealth funds, investment pools funded by government revenues, often from natural resource exports. Norway's government pension fund Global, funded by North Sea oil revenues, is the world's largest sovereign wealth fund with approximately $1.6 trillion in assets. China's China Investment Corporation holds about $1.4 trillion. The Abu Dhabi Investment Authority manages roughly $900 billion. Kuwait, Singapore, Saudi Arabia, each operates sovereign wealth funds worth hundreds of billions. Total global sovereign wealth fund assets amount to approximately $11.5 trillion, according to the Sovereign Wealth Fund Institute. Add it up. Foreign exchange reserves, $12.1 trillion. Sovereign wealth funds, $11.5 trillion. We're looking at approximately $23.6 trillion in government-controlled savings and reserves globally. $23.6 trillion. If you had this amount in $1 bills and you stacked them, the stack would reach approximately 1.6 million miles into space. That's about 6.7 times the distance from Earth to the moon. You could build a bridge of dollar bills to the moon and back more than 3 times. This is where the scale starts to break your intuition. These numbers are so large that they cease to have meaning in any tangible sense. You can't visualize them. You can't relate them to anything in your daily experience. They exist purely as abstractions, mathematical constructs that represent economic power on a scale that has never existed before in human history. And these government reserves, these sovereign wealth funds, They play a crucial role in global economic stability. When a country faces a currency crisis, it can draw on reserves to defend its currency value. When there's a global financial panic, sovereign wealth funds can step in as buyers of last resort, preventing complete market collapse. When natural disasters strike or pandemics emerge, governments can tap these reserves to fund emergency responses without immediately resorting to deficit spending. But we're still not at the largest pool. There's one category of savings that dwarfs everything we've discussed so far. One reservoir of capital so massive that it makes sovereign wealth funds look like pocket change. People save for retirement. They put money into 401ks, IRA, pension funds, provident funds, superannuation accounts. And when you add up all the retirement savings globally, accumulated over decades by billions of people, you arrive at a number that's almost impossible to comprehend. Let's start in the United States. According to the investment company Institute, total U.S. retirement assets amount to approximately $38.4 trillion. That includes defined contribution plans like 401ks, $10.6 trillion, IRA, $13.9 trillion, defined benefit pension plans, $9.5 trillion, and annuities, $4.4 trillion. $38.4 trillion. This is money that American workers have saved over their careers. Money that's invested in stocks, bonds, real estate, and other assets, all intended to fund retirement income for tens of millions of people. If you tried to count to 38.4 trillion, counting one number per second, it would take you 1.2 million years. Modern humans emerged about 300,000 years ago. You'd have to start counting before humans existed, back when our ancestors were Homo heidelbergensis, and you'd still be counting today. But the US is just one country. The United Kingdom holds approximately $3.6 trillion in pension assets. Japan holds about $3.8 trillion. Canada holds roughly $2.8 trillion. Australia, despite having a much smaller population, holds about $2.3 trillion in superannuation assets, thanks to its mandatory retirement savings system. The Netherlands, a country of just 17 million people, holds approximately $1.9 trillion in pension assets. That's about $112,000 in pension savings for every man, woman, and child in the country. The Dutch pension system is one of the most robust in the world, a model of how comprehensive retirement savings can provide security for an entire population. According to the Organization for Economic Cooperation and Development, the OECD, total pension assets in OECD countries amount to approximately $56.6 trillion. And that's just the developed economies. It doesn't include growing pension systems in emerging markets like China, India, Brazil, or Indonesia. When you add up global pension and retirement savings, including assets held outside the OECD, the number approaches $70 trillion. $70 trillion, saved by workers around the world, invested for their future retirement. $70 trillion. If you had this amount in $1 bills, the stack would reach approximately 4.8 million miles into space. That's about 20 times the distance from Earth to the moon. You could build a bridge of dollar bills to the moon and back 10 times over. If every dollar were a second, 70 trillion seconds would be 2.2 million years. That's longer than Homo sapiens has existed as a species. That's back to the time of Homo habilis, the earliest members of our genus, the first to use stone tools. This is the scale we're operating at now. Numbers so large they break human comprehension. But here's what's crucial to understand. This $70 trillion in retirement savings isn't just sitting in bank accounts. It's invested. It's deployed in the economy. It owns companies. It funds government operations. It builds infrastructure. It provides the capital that makes modern economic activity possible. These pension funds own approximately 30 to 40% of all publicly traded stocks in developed markets. They hold massive portions of government and corporate bond markets. They invest in real estate, private equity, infrastructure projects. This capital, accumulated through small, consistent savings by millions of ordinary workers, has become the foundation of the global financial system. When you save $500 a month into your 401k, you're not just securing your own retirement. You're participating in the largest pool of capital ever assembled. You're becoming part of the ownership structure of the global economy. Your savings, combined with everyone else's, form the bedrock of financial stability. And yet, we're still not at the largest pool. There's one more category, one final level of savings that encompasses everything we've discussed and more. When economists talk about global savings, they're talking about the sum of all household savings, all corporate retained earnings, all government reserves, all pension assets, all insurance reserves, all endowment funds, everything. Every dollar, euro, yen, yuan, pound, and rupee that's been saved rather than spent. According to the World Bank and IMF data, gross global savings, the amount of income not consumed in a given year, runs at approximately 26 to 28% of global GDP. With global GDP at roughly $105 trillion, that means approximately $27 to $29 trillion is saved globally each year. But we're not talking about annual flow. We're talking about the stock, the accumulated savings built up over decades. This is harder to measure precisely because accounting standards vary by country, because some savings are held in forms that are difficult to track, and because the line between savings and investment blurs at certain points. But we can estimate total global financial assets, according to McKinsey's annual report on global capital markets, amount to approximately $530 trillion. This includes all equity markets, about $120 trillion, all debt markets, about $300 trillion, and all bank deposits and other financial instruments, about $110 trillion. Not all of this represents savings in the pure sense. Some of it is leverage, borrowed monies, derivative positions. But a significant portion, perhaps $200 to $250 trillion, represents genuine accumulated savings. Money that was earned, not spent, and stored in some financial form. Let's work with $225 trillion as our estimate for total global accumulated savings. This includes everything. Your checking account, Apple's cash, China's reserves, Norway's sovereign wealth fund, every pension fund, every insurance policy's cash value, every endowment, every rainy day fund held by every entity on Earth. $225 trillion. This number is so large, it doesn't mean anything in conventional terms. But let's try some comparisons anyway. If you had $225 trillion in $1 bills, the stack would reach approximately 15.4 million miles into space. That's about 64 times the distance from Earth to the Moon. It's about 16.5% of the distance from Earth to the Sun. You could build a bridge of dollar bills from Earth toward the Sun and get 16.5% of the way there. If you laid $225 trillion in $1 bills end to end, you'd create a line approximately 21.4 billion miles long. That's enough to reach from Earth past Neptune, the furthest planet in our solar system. Neptune is about 2.8 billion miles from the Sun at its furthest point. Your line of dollar bills would reach from the Sun to Neptune and back to the Sun almost 4 times. If you tried to count to 225 trillion, counting one number per second, it would take you approximately 7.1 million years. The first hominids diverged from other primates about 6 to 7 million years ago. You'd have to start counting before the human lineage even existed, and you'd just now be finishing. But these physical analogies, while impressive, miss the point. The significance of $225 trillion in global savings isn't in its physical magnitude. It's in what it represents. It's in what it does. This $225 trillion is the ballast of the global economy. It's the stability that allows for long-term planning, for investment in projects that won't pay off for decades, for the construction of infrastructure, for the funding of research and development, for the creation of new technologies and new industries. Without this massive pool of savings, the modern economy couldn't exist. There would be no capital available for long-term investment. Everything would be hand-to-mouth, immediate consumption, no building for the future. The Industrial Revolution wouldn't have happened because there would have been no accumulated capital to invest in factories and machines. The Digital Revolution wouldn't have happened because there would have been no funding for the decades of research that made computers possible. This $225 trillion represents the accumulated surplus of human labor and ingenuity, saved rather than consumed, invested in making the future better than the present. And here's the thing most people never grasp. This pool of savings is what makes borrowing possible. When governments issue bonds to fund infrastructure projects, who buys those bonds? Pension funds, insurance companies, mutual funds, all deploying savings. When corporations issue bonds to expand operations, who provides the capital? The same pools of savings. When you take out a mortgage to buy a house, where does the bank get the money to lend you? From deposits, from savings. The entire debt structure of the modern economy, the $300 trillion in global debt securities, only exists because there's an equivalent pool of savings willing to hold that debt. Debt and savings are two sides of the same coin. One cannot exist without the other. This is the secret architecture of modern civilization. This is what nobody talks about when they discuss economic policy or financial markets or investment strategies. The foundation of everything is this massive, quiet, patient pool of savings, accumulated through countless small decisions by billions of people and institutions over decades. And it's fragile. Most people think of savings as passive. Money sitting in an account, earning interest, doing nothing. But that's not how it works. Every dollar in savings is actively deployed in the economy, creating a complex web of interconnections that most people never see. Let's trace what happens when you deposit $10,000 into a savings account at your local bank. You hand over the money, or more likely, transfer it electronically. The bank credits your account with $10,000. You now have a claim on the bank for $10,000. You can withdraw it at any time. In your mind, the money is just sitting there. But what does the bank actually do with that $10,000? In the United States, banks are required to hold a certain percentage of deposits in reserve. Until recently, this was typically 10% for most deposits, though the Federal Reserve reduced this to 0% during the COVID-19 pandemic. Let's use the traditional 10% figure for illustration. The bank keeps $1,000 in reserve, in the form of vault cash or deposits at the Federal Reserve. The other $9,000 is available to lend out. Someone comes to the bank looking for a car loan. The bank lends them $9,000 at 6% interest. That $9,000 gets deposited in the car seller's bank account, possibly at the same bank, possibly at a different one. Now that money is available to be lent out again. If it's at a different bank, that bank keeps 10%, $900, in reserve and lends out $8,100. That $8,100 gets deposited somewhere, and 10% is kept in reserve, $810, while $7,290 is lent out. This continues. Your original $10,000 deposit has created $9,000 in loans, which created $8,100 in loans, which created $7,290 in loans. Through the magic of fractional reserve banking, your $10,000 deposit has facilitated the creation of approximately $90,000 in total loans, the sum of the infinite geometric series. This is called the money multiplier effect. Your saving, your decision to not spend that $10,000, has enabled $90,000 worth of economic activity. Someone bought a car, someone else bought a house, someone else expanded their business. All funded, ultimately, by your decision to save. But it goes further. Those loans earn interest. The car loan at 6% generates $540 per year in interest income for the bank. The bank pays you, say, 1% interest on your savings account, which is $100 per year. The bank keeps the difference, $440, as profit. This profit allows the bank to pay employees, maintain buildings, invest in technology, and compensate shareholders. Your savings has created jobs. It's funded infrastructure. It's enabled economic growth. And you probably thought it was just sitting there doing nothing. Now multiply this by every savings account, every pension fund, every insurance policy, every corporate cash reserve. Multiply it by $225 trillion. The interconnections become incomprehensibly complex. Every dollar of savings is supporting multiple dollars of economic activity. Every pool of capital is connected to every other pool through lending, borrowing, investing, and trading. This is the financial system. Not the stock market, not cryptocurrency, not the flashy, visible parts that dominate news coverage. The real financial system is this quiet, invisible network of savings and lending, operating 24/7, facilitating trillions of dollars in economic activity every day. And it works. Most of the time. The global financial crisis of 2008 taught us what happens when this system of savings breaks down. When trust evaporates, when the interconnections that normally facilitate economic activity become channels for panic and contagion. In September 2008, Lehman Brothers, one of the world's largest investment banks, filed for bankruptcy. The company had $639 billion in assets and $619 billion in debt. It was massively interconnected with other financial institutions, holding their deposits, managing their investments, trading with them daily. When Lehman collapsed, it couldn't return the deposits other institutions had placed with it. It couldn't honor its trading obligations. Suddenly, every financial institution had to wonder, if Lehman can fail, who else might fail? Who else might not be able to return my deposits? Who else might default on their obligations? Trust, the foundation of the financial system, evaporated overnight. Banks stopped lending to each other. The interbank lending market, where banks with excess reserves lend to banks that need short-term funding, froze. The commercial paper market, where corporations borrow for short-term operating needs, sized up. Money market funds, considered as safe as bank deposits, broke the buck, falling below $1 per share as their holdings lost value. In a matter of weeks, $8 trillion in household wealth was destroyed as stock markets crashed. The S&P 500 fell 57% from its peak. Housing values plummeted. Retirement accounts were decimated. That $38 trillion in U.S. retirement savings, it fell to about $28 trillion by March 2009. $10 trillion gone. But the more fundamental problem was the savings themselves were at risk. Banks were failing. Washington Mutual, with $307 billion in assets, failed in the largest bank failure in U.S. history. Wachovia, with $812 billion in assets, had to be rescued through a forced merger. Citigroup, Bank of America, both required massive government bailouts to survive. When banks fail, deposits are at risk. Yes, the FDIC insures deposits up to $250,000, but the FDIC Insurance Fund in 2008 had only about $35 billion. Total insured deposits in the U.S. were over $4.5 trillion. The FDIC couldn't have covered even 1% of deposits if multiple large banks had failed simultaneously. The government stepped in. The Federal Reserve, the FDIC, the Treasury Department, they created emergency programs with names like TALP, TARP, ZPFF. The Fed lent trillions of dollars to banks. The government injected $700 billion in capital through TARP. The FDIC guaranteed bank debt. The goal was singular: prevent the savings system from collapsing. Because if people lost faith in banks, if they believed their deposits weren't safe, they would rush to withdraw their money. Bank runs would begin. Banks would be forced to sell assets at fire sale prices to meet withdrawal demands. Those sales would drive asset prices down further. More banks would fail. More people would panic. More withdrawals. More sales. A self-reinforcing spiral of destruction. This is what happened in the 1930s during the Great Depression. Over 9,000 banks failed between 1930 and 1933. People lost their life savings. The money supply contracted by about 1/3 as deposits disappeared. Without saving, without capital, businesses couldn't invest. They couldn't expand. They laid off workers. Unemployment reached 25%. The economy spiraled into the deepest depression in modern history. The 2008 crisis could have been another Great Depression. The mechanisms were the same. The risks were similar. But this time, policymakers understood what was at stake. They understood that the savings system, that $225 trillion pool of capital, had to be protected at all costs. Because without it, the modern economy couldn't function. The interventions worked. The banking system stabilized. Confidence gradually returned. By 2013, stock markets had recovered to pre-crisis levels. Retirement savings were restored. The economy resumed growth. The system survived. But it was close, terrifyingly close. And it illustrated something crucial. The global economy runs on savings. Not on consumption, not on spending, not on growth. Those things are made possible by savings. Savings is the foundation. Everything else is built on top. The $225 trillion in global savings didn't appear overnight. It accumulated over decades, through millions of individual decisions, through the development of financial institutions and instruments, through government policies and cultural norms around saving and investment. Let's trace how we got here. For most of human history, savings was minimal. Subsistence farming, which characterized most human economic activity until recently, doesn't generate much surplus. You grow enough to feed your family, maybe a little extra to trade for tools or clothes, but there's not much left over to save. Wealth was held in the form of land, livestock, or precious metals, not financial savings. The Industrial Revolution changed this. Factory workers earned wages, cash income rather than agricultural output. For the first time, large numbers of people had the opportunity to save money. They opened accounts at savings banks, institutions specifically designed to accept small deposits from ordinary workers. By the late 1800s, postal savings systems emerged in many countries, allowing people to deposit money at post offices, combining banking with an existing government network. In the United States, the postal savings system, established in 1911, eventually attracted billions of dollars in deposits from people who didn't trust commercial banks. But savings really accelerated after World War II. Several factors converged. First, incomes rose substantially during the post-war economic boom. The American middle class, in particular, saw unprecedented prosperity. People had surplus income to save. Second, governments began promoting retirement savings through policy. The Social Security system in the U.S., established in 1935, created a forced savings mechanism. Workers and employers paid taxes that funded retirement benefits. Similar systems emerged globally. The national insurance in the UK, the Canada Pension Plan, state pension systems across Europe. Third, employer-sponsored pensions became common. Large corporations established defined benefit pension plans, promising workers a specific retirement income based on years of service and final salary. These pensions accumulated enormous pools of capital that needed to be invested to fund future obligations. By the 1970s, pension funds had become major players in financial markets. In the US, pension assets grew from about $50 billion in 1950 to over $500 billion by 1975. This capital needed somewhere to go, and it flowed into stocks and bonds, helping to finance corporate expansion and government operations. The 1980s and 90s saw another shift. The rise of defined contribution plans like 401ks in the US. Instead of promising a specific retirement benefit, employers offered accounts where workers could contribute a portion of their salary, often with employer matching. The worker bore the investment risk, but also controlled the assets. This change turbocharged retirement savings. By 2000, 401k assets had grown to about $1.7 trillion. Workers were now directly investing in stock and bond markets through their retirement accounts. When combined with IRAs, mutual funds, and brokerage accounts, ordinary Americans owned a significant portion of the stock market. The same pattern played out globally. Australia introduced mandatory superannuation in 1992, requiring employers to contribute a percentage of worker wages to retirement accounts. Within 30 years, Australian superannuation assets grew to over $2 trillion. Singapore's Central Provident Fund, Hong Kong's Mandatory Provident Fund, Chile's private pension system, all variations on the same theme: mandatory or heavily incentivized retirement savings. Sovereign wealth funds emerged in the late 20th and early 21st centuries. Resource-rich countries like Norway, the UAE, and Saudi Arabia established funds to save oil revenues for future generations. Singapore and China created funds to invest their foreign exchange surpluses. These funds grew to trillions of dollars, becoming major investors in global markets. Corporate savings also accelerated. Globalization and technological change allowed companies to achieve unprecedented profitability. Apple, Microsoft, Alphabet, they generated so much cash that they couldn't spend it all on operations and capital expenditures. They accumulated massive reserves. And households, particularly in Asia, maintained high savings rates. China's household savings rate has historically been above 30%, driven by cultural norms, inadequate social safety nets requiring people to save for healthcare and retirement, and policies that made it difficult to borrow. All of these trends converged. Institutional frameworks were built. Cultural norms shifted. Technology made saving and investing easier. And over decades, the pool of global savings grew from hundreds of billions to tens of trillions to hundreds of trillions of dollars. It's the largest accumulation of capital in human history. And it happened mostly quietly, in the background, while people focused on more visible economic phenomena like GDP growth or stock market performance. The future of global savings is uncertain. Several trends are pulling in different directions. On one hand, demographic aging in developed countries means millions of people are approaching retirement. They'll begin drawing down their savings, selling assets to fund consumption. This could put downward pressure on asset prices and reduce the total pool of savings. Japan, with the world's oldest population, is already experiencing this. Japanese households are net sellers of financial assets as retirees liquidate savings. This has implications for Japanese government finances, as domestic savings have traditionally funded Japan's massive government debt. Other developed countries, including the United States and most of Europe, will follow this pattern over the coming decades. On the other hand, Emerging markets are in their prime savings years. Countries like China, India, Indonesia, Brazil, they have young, growing populations entering peak earning years. If they maintain high savings rates, they could offset declining savings in developed countries. China alone, with household savings already exceeding $20 trillion, could add trillions more to the global pool over the next decade. Technology is also changing how people save. Digital payment systems, robo-advisors, automated savings apps, they're making it easier for people to save and invest. Fintech companies are reaching populations that traditional banks ignored, bringing millions of people into the formal financial system. But there are risks. Climate change could destroy trillions of dollars in assets. Coastal real estate, agricultural land, infrastructure built for historical climate conditions, all could lose value as weather patterns shift. This would reduce the total pool of savings. Geopolitical tensions could fragment the global financial system. If the US dollar loses its status as the world's reserve currency, or if countries build parallel financial systems to avoid sanctions, the efficiency of capital allocation could decline. Savings might become trapped within regions, unable to flow to the highest return opportunities. Government debt, already at record levels in many countries, could crowd out productive investment. If governments continue borrowing to fund current consumption rather than investment, savings will be directed toward unproductive uses. But perhaps the biggest question is whether the cultural shift toward saving continues or reverses. Younger generations in developed countries have lower savings rates than their parents did at the same age. Student debt, high housing costs, stagnant wages, all make it harder to save. If this trend continues, if each generation saves less than the one before, the pool of global savings could shrink even as populations grow. Lower, governments could implement policies to boost saving. Automatic enrollment in retirement accounts, higher employer match rates, tax incentives for savers, financial education programs, all could increase savings rates. The future is genuinely uncertain. We're at a pivot point. The decisions made over the next decade, by governments, by corporations, by individuals, will determine whether the pool of global savings continues growing or begins shrinking. And that matters, because as we've seen, savings isn't just about individual financial security. It's about the stability of the entire economic system. Let's step back and consider what we've learned. We started with $80 in a wallet, lunch money, gas money, a tangible, comprehensible amount. We climbed through personal savings, household savings, corporate cash reserves, government reserves, pension funds, all the way to $225 trillion in total global savings. At each step, the scale increased by factors of 10, of 100, of 1,000. The numbers became abstractions, impossible to visualize, detached from any human experience. But what we've really been exploring is the foundation of modern civilization. Every building you see was constructed with borrowed money, borrowed from someone's saving. Every business that employs people was started with capital, capital that came from savings. Every government service, every road, every school, every hospital, funded at least in part by borrowed money, borrowed from pools of savings. The entire productive capacity of the modern world rests on this foundation of accumulated capital. And most people never think about it. They see their savings as inactive, as opportunity cost, as money that's not working. But the opposite is true. Savings is what makes everything else work. When you deposit money in a bank, you're not removing it from the economy. You're making it available for someone else to borrow, to invest, to build something. When your pension fund buys corporate bonds, it's providing capital for businesses to expand, to hire workers, to develop new products. When a sovereign wealth fund invests in infrastructure, it's enabling the construction of ports, airports, power plants, the physical systems that enable commerce. This is what savings does. It's not passive. It's the most active thing in the economy. It's the fuel that powers growth, innovation, progress. And when savings breaks down, when people lose faith in the system, when banks fail and deposits disappear, the entire structure collapses. We saw this in the Great Depression. We almost saw it again in 2008. The lesson is clear. Economic stability doesn't come from consumption. It doesn't come from government spending. It doesn't come from central bank interventions. Those things can help at the margins. But the foundation, the bedrock, is saving. A society that saves is a society that has options. It can weather crises. It can invest in the future. It can build resilience. A society that doesn't save, that consumes everything it produces, is a society living hand to mouth. Any shock, any disruption, any unexpected event becomes a crisis. This is true at every level. For individuals, for businesses, for governments, for the global economy. Savings is the buffer. Savings is the stability. Savings is what allows us to plan for the future rather than just react to the present. There's a famous economic concept called the paradox of thrift. It goes like this. If everyone tries to save more at the same time, spending falls, businesses cut production, workers lose jobs, incomes decline, and paradoxically, people end up saving less because they have less income to save from. This idea, popularized by John Maynard Keynes during the Great Depression, has influenced economic policy for nearly a century. It's the intellectual foundation for stimulus spending, for encouraging consumption, for policies that prioritize demand over supply. But it misses something crucial. The paradox of thrift is about short-term dynamics, about what happens in a recession when everyone suddenly becomes fearful and stops spending. It's not about the long-term role of savings in economic stability. Over the long term, societies that save more grow faster and are more stable than societies that save less. This is empirically true. Look at the economic development of East Asia. Countries like Japan, South Korea, China, Singapore. High savings rates, rapid capital accumulation, sustained economic growth. Compare this to countries with persistently low savings rates that rely heavily on foreign capital, that consume more than they produce. They're vulnerable to financial crises, to sudden stops in capital flows, to debt crises. The paradox of thrift confuses a short-term coordination problem with the long-term necessity of capital accumulation. Another common misconception: that savings and investment are opposites. Financial advisors often frame it this way. Don't just save, invest. as if putting money in a savings account is wasteful, but putting it in stocks is productive. But this is a false dichotomy. Savings and investment are the same thing viewed from different perspectives. When you deposit money in a bank, the bank lends it out. That lending is investment. Your savings becomes someone else's investment. When you buy a stock, you're providing capital to a company. That's savings being deployed. The company uses that capital to invest in equipment, facilities, research. When your pension fund buys government bonds, the government uses that money to build infrastructure. Your savings becomes public investment. At the aggregate level, savings equals investment. It's an accounting identity. One cannot exist without the other. The form changes, the intermediaries change, but the fundamental truth remains. Savings is the source of all investment. A third misconception: that the wealthy have too much in savings and should be forced to spend it. This argument appears frequently in discussions about inequality. Billionaires have too much money sitting idle. Tax it and redistribute it so it gets spent and stimulates the economy. But this misunderstands what wealthy people do with their money. Billionaire wealth isn't sitting in checking accounts. It's invested. It owns companies. It funds venture capital. It finances real estate developments. It provides capital for startups and growth companies. Jeff Bezos' wealth is mostly Amazon stock. That stock represents ownership of the company, the warehouses, the technology, the logistics network. It's deployed capital, actively used in production. Elon Musk's wealth is mostly Tesla and SpaceX stock. That wealth is building electric vehicles and rockets. It's not sitting idle. You can argue about whether this is the optimal use of capital. You can debate tax policy, but you can't claim that wealthy people's savings are inactive. They are the most active savings in the system, funding the most capital-intensive, highest-risk investments. Understanding savings correctly means understanding that it's not passive, that it's not opposite to investment, and that its presence in the system, in large quantities, is what enables economic stability and growth. So what does all of this mean for you? For your decisions? For your financial life? First, recognize that your savings matters. Even if you only have a few $1,000s saved, you're participating in this system. You're contributing to economic stability. Your decision to save rather than spend, multiplied across millions of people, creates the capital that funds everything else. This doesn't mean you should save every penny. Balance is important, but understand that saving isn't selfish or economically wasteful. It's productive. It's necessary. It's socially valuable. Second, protect your savings. Keep your money in insured institutions. Diversify across different types of assets. Don't chase yield in risky investments that you don't understand. Your savings is your stability. It's what allows you to weather job loss, medical emergencies, unexpected expenses. Don't gamble with it. Third, think long-term. The financial system, despite its occasional crises, is remarkably resilient over long-time horizons. Markets recover. Economies grow. Assets appreciate. If you're saving for retirement, you have decades. Short-term volatility doesn't matter. What matters is consistent saving, broad diversification, and patience. Fourth, understand the system you're part of. Your savings doesn't just sit in an account. It's lent out. It funds businesses. It builds infrastructure. It creates jobs. You're not just saving for yourself. You're providing capital to the entire economy. This gives you a stake in economic stability. When you hear about banking regulations, or central bank policies, or government debt levels, these aren't abstract issues. They directly affect the safety and value of your savings. Fifth, advocate for policies that protect savings. Sound banking regulation. Deposit insurance that's adequately funded. Central bank policies that maintain price stability. Government fiscal responsibility that doesn't crowd out private investment. These aren't partisan issues. They're about protecting the foundation of the economic system. Everyone, regardless of political affiliation, benefits from a stable financial system built on a solid base of saving. We've journeyed from $80 in a wallet to $225 trillion in global savings. From something you can hold in your hand to a number so large it has no physical meaning. But the real journey has been understanding what savings actually is. It's not money sitting idle. It's not opportunity cost. It's not economically wasteful. Savings is the foundation of everything. It's the accumulated surplus of human labor and ingenuity, stored and deployed to build the future. It's the stability that allows for long-term planning, for investment in infrastructure and technology, for weathering crises without collapse. The modern economy, with all its complexity and sophistication, rests on this simple foundation. People earning more than they spend, and making that surplus available for others to borrow and invest. Without saving, none of this exists. No factories, no offices, no infrastructure, no research and development, no growth. With saving, everything becomes possible. Capital accumulation, technological progress, rising living standards, the capacity to solve problems that seemed insurmountable. This is why savings quietly anchors economic stability. Not because it's flashy or exciting, not because it dominates headlines, but because it's the bedrock on which everything else is built. When you look at your bank account balance, you're not just seeing your personal financial security. You're seeing a tiny piece of the largest pool of capital ever assembled in human history. You're seeing your contribution to the foundation of modern civilization. That $80 in your wallet, it's connected to $225 trillion in global savings. Your checking account, it's part of the system that funds every business, every building, every innovation. You're not separate from this system. You're part of it. Every time you save, you're strengthening it. Every time you make a deposit, you're providing capital for someone else's dream, someone else's business, someone else's future. This is the hidden architecture of modern life. The quiet foundation that nobody talks about but everyone depends on. The accumulated savings of billions of people, deployed through millions of institutions, funding the infrastructure of civilization. And now you understand it. The next time someone tells you that saving is wasteful, that consumption drives the economy, that you should spend more and save less, you'll know better. You'll understand that savings isn't the opposite of economic activity. Savings is what makes economic activity possible. You'll understand that the $225 trillion in global savings isn't idle capital. It's the most active capital in the world, working 24/7 to fund growth, innovation, progress. You'll understand that economic stability doesn't come from stimulus spending or central bank interventions. It comes from the patient accumulation of capital, built up over decades through millions of small decisions to spend less than we earn. This is the secret architecture. This is what makes everything else possible. This is why savings quietly anchors economic stability. Thank you for taking this journey with me. If you found this exploration valuable, please consider liking and subscribing. It really helps the channel grow and allows me to keep making content like this. And remember, the next time you look at your savings account, you're not just seeing money sitting there. You're seeing your contribution to the foundation of the global economy. Small in absolute terms, but infinitely important when combined with everyone else's. We're all savers. We're all part of this system. We're all contributing to the stability that makes modern life possible. Sleep well, knowing that your savings, however modest, is part of the largest pool of capital ever assembled. Part of the foundation. Part of what keeps the world running. And may you never look at your bank balance the same way again.